Keppel DC REIT suffered a big drop in share price after its Q3 2023 business updates. Over the year, it has been increasing its assets by 80% from Q1 2019 till now. However, DPU has increased only by 30%. DPU has been inching down in recent quarters. Let's take the opportunity to examine the REITs over a longer time period to reconcile the business to the share price and DPU. Before we continue, a quick reminder. While Keppel DC has been increasing its investment property, NPI yield has been inching down. Hence, gross revenue and NPI were increasing initially, but flat for many quarters recently. To fund the increase in investment property, borrowing has increased by 113% for the period. Unfortunately, the cost of debt has been rising. It was 1.7% in Q1 2019. Since 2022, it has risen quickly. It reached a high of 3.5% in the latest quarter. With the rising cost of debt and more borrowing, its finance costs increased significantly. The finance costs are in half-yearly except for the latest Q3, which they released for the first time. Average leverage is moving higher to around 36-37%. Interest cover has been going down rapidly from a high of 12 times to 5.4 times. The earnings are not covering its interest expense as well as they used to. Keppel DC REITs also did equity fundraising. The number of units increased by 27% since Q1 2019. Another cost item is the manager fees. The fees is a percentage of investment property, net property income, acquisition price, divestment price. The base fees increased by 50% since Q1 2019, performance fees by 88%, total fees by 74%. As a percentage of gross revenue, manager fees is taking a bigger chunk of the gross revenue from 8.2% to 9.7%. The bulk of the fees are the base fees, which is calculated as a percentage of investment property. Nothing to do with the performance of this property contributing to income and DPU. Let's put together all the variables explained just now to understand how they affect each other and Keppel DC as a whole. The increase in investment property leads to more borrowings and equity fundraising. With more borrowings and higher cost of debt, financial costs jump and it affects distributable income. The higher borrowings increase the leverage and the higher finance costs lower the interest cover. With more acquisition and lower yields, net property income has increased less and stayed flat as we saw in recent years. Another major cost item is the manager fees, which has been inching up. The fees are a percentage of investment property and NPI. Hence, distributable income is affected in three main areas: the lower NPI yields, the higher financial costs, and higher manager fees. Last, Keppel DC did equity fundraising and more units were issued. The distributable income has to be shared with more units and this affects the DPU. Putting the variables together, you can see how these numbers are related to each other and how they affect DPU directly and indirectly. Hope you have a good understanding of Keppel DC REITs by now. You can see why the market is reacting so negatively to their Q3 results, news about new telemedia and its plan for more acquisition. Interest cover is weakening and the balance sheet is not strong. Any bad news on customer and acquisition will be taken badly. What's more, the 10-year US Treasury yield is rising to the highest in 16 years. The share price is currently trading at $1.78. Dividend yield for the trailing 12 months is 5.69%. NAV per unit is $1.36. Things to look out for are interest rate and occupancy. It has less headroom for unforeseen circumstances. A key question to ask ourselves is, what is Keppel DC REIT's mode to sustain its DPU? Long-term financial performance is the best validator of strength. Looking at their financial performance, I'm not convinced of the quality of mode so far. Let's take a look at the weekly chart since its listing in December 2014. It broke the 182 support this week after the Q3 updates. This was the March 2020 COVID low. Volume has been very high. There's no clear reversal signal so far. The next support is 160, which was the October 2020 low. At 160, the trailing 12-month dividend yield is 6.33%. This is all I have today. Hope you find it useful. Do remember to like, subscribe, and share your perspective. If you like such stocks analysis, you may want to watch other stocks I cover in this channel. Thank you.